The Reserve Bank's role is to try to reduce the likelihood of financial firms failing and being unable to meet their claims. So it's prudential supervision in the sense that we are trying to make sure that these firms run themselves prudently. We set various minimum standards that banks, finance companies and insurance companies have to meet. And then we also monitor or supervise against those standards. So we meet regularly with banks' boards of directors and chief executives, and we check that they are monitoring their banks prudently and clearly meeting the minimum standards that we set them.
Why should members of the public be concerned about the Reserve Bank's role in regulation?
They have a stake in the financial system operating efficiently and not falling over. So the financial system is very interconnected. It's like the sort of plumbing that holds the whole financial system together. So you get these flows around the economy which go between banks. And when you get a failure of that, or you get a failure of one bank to meet its obligations, then it can have wide and very damaging effects across the whole of the rest of the financial system and the economy and people's lives.
What is it the Reserve Bank does to protect New Zealanders' financial security?
The Reserve Bank doesn't completely insure against failure. What we aim to do is to reduce the likelihood of failure through our regulation and supervision.
So what sort of things can go wrong that will impact on our financial security?
Well, there's been three good examples recently. One is a very global event, so that's the global financial crisis. That was made in America. Too many people lent too much money to borrowers that couldn't repay on their houses. And so you got this kind of domino effect. We had banks falling over, not just in the US, but in the UK and Europe, and our banks suffered as well at the time. Secondly, you can have a homegrown problem, like the finance company collapses. The people running those finance companies were taking larger risks than the people that were putting money with the finance companies expected them to take. And then you can have something like the Canterbury earthquakes. There are a couple of insurance companies that actually were unable to meet all their claims as a result of the Christchurch earthquake. It's been one of the biggest disasters for the insurance sector worldwide, let alone in New Zealand. We try to reduce the likelihood of companies failing, but we can never give a cast-iron guarantee that they're not going to fail. So people do have to take responsibility themselves for their own investment decisions, for their decisions about who they insure with.
So how do we do that?
Through looking at the credit ratings is a very good way. You might have a company that is in the A range, and that's a relatively low risk. A company in the B range or C range is a relatively higher risk.
Where do the public go to find out about these ratings?
From the company's own website. They should be disclosed there. And there is also publications on our website that explain credit ratings. There is a real responsibility on members of the public to monitor their own investments, to monitor their insurance companies, and to make sure that they're happy with the risk that they're taking there.